Information presented is for educational purposes only, and views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate. Information does not intend to make an offer, recommendation, or solicitation for the sale or purchase of any securities.
Welcome, everyone. I'm Jason Nickerson, President and Chief Operating Officer at John G. Ullman Associates, and this is Meeting the Market. This monthly series is designed to keep you informed on the economic news, market developments, and trends shaping today's investment landscape. Each episode breaks down recent market activity, highlights key events to watch, and discuss what may lie ahead. With nearly 30 years in the financial services industry, my goal is simple: to provide clear, timely, unbiased insights on what matters most so you can stay informed and confident in a constantly evolving market. So with that, let's meet the market. Let's start with some macro moments. We enter April with an economy that continues to show resilience, but one that's navigating a more complicated backdrop than earlier in the year. Productivity remains one of the strongest pillars of the U.S. economy. AI-driven automation, reshoring, and heavy investment in energy and data center infrastructure continue to support above-trend productivity growth. While the 5% pace from late 2025 has cooled, productivity is still strong enough to help the economy absorb higher rates. GDP expectations for the first half of 2026 have now moderated after the softer 1.4% fourth quarter reading. Most forecasters are now expecting steady but slower growth in the 1.5% to 2% range, not booming, not contracting, just moving forward. There is a new dynamic that's being discussed in the labor market, one of the most important macro conversations right now, and that is the decoupling between unemployment and economic growth, something we have not seen in decades. Larger technology companies have announced significant layoffs in recent months, yet the broader economy continues to expand. This divergence is being driven by AI-enabled productivity gains, which allows companies to do more with fewer people, automation of routine knowledge work tasks, restructuring in technology where firms are reallocating resources towards AI infrastructure rather than headcount, and strong labor demand in non-tech sectors, which is offsetting tech layoffs. The result is a labor market that looks softer on the surface, but still fundamentally supported by wage growth, job openings, and hiring in areas tied to infrastructure, energy, and services. This is a shift worth watching. If AI continues to accelerate productivity, we may see periods where unemployment ticks higher without signaling a recession, a break from traditional economic patterns for sure. Coming to the Federal Reserve, the Fed's March meeting delivered no surprises. They left rates unchanged and kept a cautious tone. After 3 rate cuts last year, policymakers want more clarity before moving forward again with any more rate cuts. The challenge here is energy. The conflict involving the U.S., Israel, and Iran has pushed crude oil sharply higher, and that's complicating the inflation infrastructure and picture. If energy-driven inflation persists, the Fed may delay cuts deeper into the year. The Fed, ECB, Bank of England, and Bank of Japan, all the major global central banks, are all signaling caution. None want to tighten, but none are ready to aggressively ease either. Markets are parsing every word for clues about the path ahead. And with the geopolitical situation the way it is, the risk remains. The biggest factor being oil is up more than 20% over the past several weeks. And markets are extremely sensitive to headlines. Any escalation in this geopolitical situation, any escalation at all, could ripple through inflation, consumer sentiment, and corporate margins. The bottom line here of the macro story is that there are solid fundamentals, there is rising geopolitical risk, a labor market that's in transition, and a Federal Reserve that's on pause until inflation becomes clearer. If inflation reaccelerates, even in one category like energy, rate cuts can continue to be delayed. Now on to some more specific current headlines around companies and so on. Let's shift to the corporate landscape, where several themes are shaping market behavior. Again, the big headline in this area is tech and artificial intelligence. AI remains the market's gravitational center. Companies tied to data center build-out, power infrastructure, semiconductor supply chains continue to attract strong investment flows. Mega-cap tech remains dominant, but mid-cap AI adjacent names are gaining traction as investors look for the quote-unquote next layer of beneficiaries. Energy is in focus as well, where energy companies are looking at higher crude prices that are boosting revenue expectations for integrated oil majors and refiners, but for transportation, manufacturing, consumer good companies, rising input costs that higher crude prices are becoming a real headwind. Banks are navigating a mixed environment. Net interest margins have stabilized with the Fed on hold, but loan demand is softening. Credit quality remains healthy, but analysts are watching closely for signs of any stress if energy prices stay elevated. Consumer companies remain resilient as the consumer does, supported by wage growth and stable employment. But pressure is building. Higher energy costs and lingering inflation are squeezing discretionary budgets overall. Earnings calls this quarter have focused heavily on pricing power, who still has it and who's losing it. Industrials and small caps are quiet, but there's a meaningful rotation certainly underway. Investors are showing renewed interest in industrials, infrastructure plays, and small caps with attractive valuations. It's early but notable, especially after 2 years of mega cap dominance. As we look ahead to the next 30 days, there's 3 developments we're watching that can really shape the market going forward. This month and beyond, they are more interconnected than usual. First, the Federal Reserve's tone. Markets want clarity around how policymakers are interpreting the recent rise in energy prices, the persistence of certain inflation components, and the timing of future rate cuts. The updated dot plot will give us a clearer sense of where the Fed expects rates to land by year end and whether the path of easing is narrowing or widening. Number 2, geopolitical stability. The Middle East remains the biggest wild card. Any escalation could push oil higher, shift inflation expectations, and pressure both consumer sentiment and corporate margins. Markets are extremely headline sensitive right now, and volatility can spike quickly if tensions rise. And number 3, we're entering earnings season again, the most important catalyst. We're entering this season, and this one carries more weight than any in the past year. With macro signals mixed, geopolitical risk elevated, corporate guidance becomes the clearest forward-looking indicator we likely have. This season will help answer the questions that matter most. Are companies still seeing stable demand? Are higher energy costs squeezing margins? Are AI-related productivity gains translating into profitability? Are CEOs planning to hire, invest, or pull back? The tone of these earnings calls, not just the numbers, will help determine whether market leadership broadens beyond the mega cap tech or remains concentrated in just a handful of names. So in short, the next month is all about policy signals, geopolitical stability, and what corporate America tells us about the road ahead. Now, what does this mean for you? This month isn't about reacting, it's about interpreting. Use earnings season to reassess your positioning. Not every company will navigate higher energy costs or shifting demand equally. You should review your cash strategy. Yields remain somewhat attractive, but they won't stay this high once rate cuts begin. Check your allocation. Again, after 2 strong years for equities, many portfolios are unintentionally overweight stocks. And stay flexible, not fearful. Volatility around geopolitics and earnings is normal, not a signal to abandon your plan. At our firm, we tell clients this: if the current environment makes you uneasy, adjust your risk. But don't chase headlines or try to time the next big move. This is the moment to stay engaged, stay informed, and stay disciplined. The market is shifting, leadership is evolving, and an earnings season will help clarify the path forward. And with that, that is this month's Meeting the Market. We'll see you next month.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.